Hello students. Today we're going to get into a case study that has to do with futures on a conglomerate, on a German conglomerate that essentially blew up in 1993. A very famous case on a company called Metallgesellschaft. A company that was a fully integrated energy company. They started out as a mining company. They got into the oil exploration, full integration from upstream to midstream to downstream. So they were storing oil, they were drilling for oil, they were selling oil in a very interesting time. But they blew up and went out of business because of the poor hedging. So here again is another case of why don't oil companies, why don't some commodity companies, and whether it's farmers or wheat or cattle companies, they don't hedge their commodity variability at all. And you would say, well, that's kind of stupid. You can have oil prices go from $10 to $100. You can have wheat go from 50 cents a pound to $1.50 a pound. So why would you not protect that variable cost so you know what your profitability is going to be on the other side? But let's kind of get into this case. It's a little complicated, but as we move through case studies, that's where you really want to more and more dig in. And then again, we're going to circle back around on a lot of these case studies and say, well, what should have the company have done to not blow up? What would have been a better way to hedge that risk? So that's sort of the theme. I'm going to throw a lot of case studies at you on the front end, and then on the back end, as we go through Nattenberg, as you learn what some of these tools are, some of the nuances of futures, forwards, options, swaps, that can we use these in a different way to do a better job of hedging. And that's really the theme of the class. So let's get into this. 1993, they lost about $1.5 billion, put them out of business. The oil market moved from backwardation, when the near-term price is higher than the longer-dated price, to something called contango. As oil prices fell, Metallgesellschaft, Hedges lost more money than it gained on the other side of the trade, on the short side. So what's kind of interesting is, to give you a perspective, is that your futures market had only been around for 10 years. It started in the 83, 84, they started to sell oil futures. So there wasn't a long history on the futures market in the oil patch. And I think you have to put that in perspective, because anybody that is a Hedge 101 hedge educated practitioner or student would know that you would never set up a reverse calendar spread, and there's a word you haven't learned, but you will learn, on a commodity that's in backwardation. If a commodity is in backwardation, you would usually sell the front month and you would buy the back month. They did the exact opposite. And at first, when I started to teach this case study, I'd scratch my head, because the 101 student would never do a reverse calendar spread in a backwardation position, because we would always say contango backwardation, the term structure of any commodity, backwardation is the unstable position and contango is the stable condition. In other words, let me use it this way. If there's a hurricane in a particular market, I'm using that as an analogy, it's an unstable state, so you'd move into backwardation. 2020, most commodities were steep backwardation. And backwardation just means that people and companies are willing to buy their commodity today because they're not sure that commodity is going to be available tomorrow. And you can understand, during the COVID-19 crisis, that's what we saw. We saw a lot of companies saying, no, we better buy our steel, we better buy our oil now, because I'm not sure there's going to be supply chains to even buy this stuff in the future. So what happens is everybody starts buying the front end, and of course the front end is higher than the back end. Analogous, students, as if you were finance majors, analogous to the inverted yield that we're in on bonds right now, where the short end is trading at 5 and the long end is trading at 3.5 on the bond yields. That's what we call an inverted yield curve, or the yield curve is in backwardation. Normally, as you go on in time in interest rates, if you buy a 10-year bond, you're going to get paid for buying duration. You're going to get paid for the risk of going long term. So in a normal market, higher interest rates go along with longer duration. That's called contango. That's a normal market. When markets become unstable, when the Fed rips interest rates as much as they did on the front end, you have what we call an inverted yield curve, or a backwardated yield curve. And we're going to get into that in just a minute. We're going to get a little bit more into backwardation and contango, which is in your study material. But let's go into Metallgesellschaft, excuse me. First of all, understand that they were a fully integrated company. By 1982, they had bought into Castle Oil, a 49% stake in Castle Oil, which was a totally integrated U.S. Energy company. As I said, they're a German conglomerate, mostly started as a mining company, and they decided they wanted to get into the oil market. Now, remember, the oil market, or the futures market, was only around for 10 years, and in most of that time, the markets were in backwardation, and you have to understand why, because if you remember from the history books, when you had, let's say, from Richard Nixon going forward, remember you had price controls, you had massive embargoes by OPEC. Your parents probably could tell you that there was gas lines, and you could only get gas on odd or even days. So literally, there would be gas lines around the block because there was no oil coming from the Middle East. The U.S. hadn't developed their oil industry as big as it is today. And so what you had the fall of the Soviet Union. You had the first Gulf War with essentially H.W. Bush, when Iraq was powerful and they attacked Kuwait. So you had a lot of geopolitical things going on in through the late 70s and into the 80s that kept the oil market in backwardation. So their head trader, which came from Louis Dreyfus, sort of had a reputation for really making a lot of money for these commodity companies, but he played in a backwardated world, and backwardation was the flavor. It wasn't contango. It was a market that was very unstable because of the embargoes in the Middle East. Our GDP was much more tied to energy than it is today. So you got to understand, why would anybody put on a trade that they put on, which basically said we're going to go long the front end in a backwardated market, and we're going to go short the long end? It didn't make any sense. So anyway, this conglomerate comes in, and they're fully integrated. So they're downstream. They've got a bunch of oil that they're selling, long-dated contracts at a fixed price. They're also midstream, and they're also drilling. So they're all over the board. So what they did was, the margins became very competitive, and they decided to come out with a contract that they told their buyers of gasoline and oil, hey, listen, we'll fix your price for 10 years. And not only will we fix your price for 10 years, we will give you an opportunity to get out of your contract, exercise your option if prices go higher. If the spot moves higher, we'll let you exercise your call option, so to speak. And so it was a contract that attracted a lot of buyers. And they had sold something like 160 million barrels going out because everybody wanted that contract. It was like too good to be true. So how were they able to do that? What they said was, okay, here's what we're going to do. We're going to be in a situation where we're going to short forwards as long as 10 years out. We're going to short forwards. Now, when you're short a future, you're protecting the downside price, right? So you're saying, we're going to sell you oil at a fixed price, and I need to protect that downside, so they're going to short. So they were hedged on the downside in those long-dated contracts. But they also had an exercise if the prices went up. So they wanted to take advantage. They said, well, what if the prices rise? We want to be able to let these people exercise their call option, so to speak, or their derivatives contract. So they said, well, let's do this. Let's protect our price on the long end and then hedge off the risk of sort of this contract we're selling going forward on the forward price that we're going to give the users or the buyers of this contract, who are giving them to let them appreciate in the rise in prices, giving them 50% of the exercise price on those futures. Let's give them the opportunity. And the way we're going to do that is let's buy short-dated forward futures, 1 month future contracts. So what you had was a situation where if prices had dropped on that long end, they were protected. And of course, if prices rose, they would lose money. Let's do this. Let's buy short-term prices. So if they buy standardized futures on the short end, then what we're going to do is we're going to lose money if the price goes down, but we're going to be hedged on the other side, on the downstream. And if prices rise, we'll essentially cancel out the long end with the short end. And that's exactly what they did. And it worked for a little bit. It worked fine for a little bit because if prices kept rising on oil, which it did initially, they would be making money on the front end. And of course, then they were protecting if prices are rising on their downstream, because remember, they're short of future. If prices are rising, you're going to get a margin call, right? We talked about that in one of the previous studies, that if I have a short future and prices are rising, my short future starts to get margin calls. Well, remember, ladies and gentlemen, this is a forward contract. It's an over-the-counter contract. It's not a standardized futures contract. So we're talking about the difference in mark-to-market value. So this is the trade that they initially put on. Now, as I just said, future contracts get daily mark-to-market. Forward contracts do not mark-to-market. There's no margin until the contracts come due, or there's no settling of the trade. And this is why there's a fight, and we talked about this. There's an article that I'm going to post from the Financial Times talking about the fight between the OTC world and the exchange-traded futures market because of this margin problem, which has destroyed companies. We talked a little bit about that the last time. So what they did was they did something called a stack and roll hedge on their short-dated contracts. Now, these are futures. Futures have a margin, mark-to-market margin. And they're fine because as long as prices rise, they're going to make a ton of money, because when you do a stack and roll, let's assume they're selling 10-year forward contracts, and let's say they're selling 160 million barrels of forward contracts. They're going to then do this. They're going to sell 160 million or buy 160 million standardized future contracts on the front month to hedge their long-term obligation. And they're going to stack it. And then they're going to roll to the next month. As those contracts roll off, they're going to roll it out to month 2, then roll it out to month 3. And if they think that they're going to keep sort of this rolling 10-year return, they'll just roll out the same amount. If they think they're going to sell less, if 160 is going to be 150, 140, they'll peel off some of those contracts as they roll it. So you can see they're highly leveraged on the front end, and the front end is equaling all the contracts they've sold on the back end. So you've got a lot of leverage on the front end, but it's roughly equaling over a 10-year period. You're spreading out that 10-year forward, and you're stacking the front end on the futures. And that's called a stack and roll. We're going to get more into stack and roll versus strip, which strip is just you're buying a contract every month, 1, 2, 3, 4, 5, until it rolls out to a 10-year contract, let's say. But let's just stick to this particular case. And so they do a stack and roll hedge against a fixed forward contracts. All right, so let's go. Why would the futures market be in backwardation? The expectation that there, as I said, won't be a supply in the future, so companies are willing to pay higher prices today. 2020 is a great example of backwardation. In times of high uncertainty, the roll yield is positive, but the expected return on the future is back to its normal state. And what do I mean by that? Well, the roll yield is, think about this. I hold a future contract, whether it's, let's say, 1 month, 2 months, 6 months, whatever. As that matures, as that moves towards maturity, what happens is that future goes up in value. And that's definitely a benefit if I'm long a futures contract. My roll yield is positive. And of course, that's what you had with Metallgesellschaft, because they were saying, hey, we're going to get a positive yield. We're going to be buying a future. We're going to be selling it at a higher price, even if prices don't move because it's in backwardation. We're buying the future cheaper than the spot. Then you can buy the spot. Let's talk about the term structure on contango. Contango is a situation, the future is usually in contango based on the expectation of future supply shortage. In other words, it's saying, hey, in the future, I'm going to have to pay up for my commodity because of normal usage, because prices tend to rise in normal markets. Think about contango as a sunny day and backwardation is a snow blizzard, okay, if you would. This product produces a significant negative roll yield, and buying higher priced, longer dated future contracts, selling them at lower prices as they approach maturity, and rolling the proceeds into yet another long dated future contract results in a loss. And here's a slide I did for the Financial Advisor magazine, and they asked me to do a lecture, so I stole one of my slides. And here you can see how the future rolls down to spot, and then you have to rebuy that longer dated future. It creates a loss, and that's just a hard loss. So what you have is, to understand the term structure, backwardation is a downsloping curve. And of course, if these are the futures going out in time, you can see that I could buy a future 2 months or 3 months out, and it's going to move up. So that's a positive roll yield. I'm going to make money as the future moves towards the spot. This is contango. Initially, the position is spot is greater than the future, and that's backwardation. And then what we get is moving back to a normal state, which is contango, and that is where, in this particular case, the spot is less than the future, and that's the negative roll yield. Now, what tends to happen, though, is the front end is very whippy, where the back end is not very whippy. Now, whippy's not a word, but what I'm really trying to say is, think about a whip. Whereas that front end of that whip is moving a lot, the back end doesn't move a lot. You can look at the difference here in how you can get it on the front end. You can get a situation where you start moving into contango, and you're moving a lot on the front end. You're not moving a lot on the back end. But if I'm long futures and it starts to move into backwardation, and I'm short term as opposed to long term long, my losses are far greater than my back end. And so understand that Metallgesellschaft, what they did was they loaded up on long futures, and they basically sold a ton of forwards, long dated short forwards. So here they're mark to market, here they're not. Forwards made money, but no mark to market cash. So what had happened was that they took massive losses on their long futures and got margin calls. And the money that they made by their short forwards wasn't booked because there was no actual mark-to-market daily settlement. So they lost a ton here, but they couldn't book what they made here. That's number one. And number two, the money they lost here was so much greater than the money they made here. So you could say that the company was severely overhedged, that yes, a strip would have been much better, because remember, a strip is you're sort of going out over time, so they would have sort of realized a loss, but maybe it would have been averaged or taken the median of that loss, whereas they just stacked all their longs on the front end. And they couldn't book any of their profits. And that was the profit. That was a problem, because one is mark to market, doesn't have margin calls. Where they were, they had tons of margin calls. So they book the losses on the futures, don't get to book the gains on the forwards. And the gains on the forwards were much less than the losses on the futures. And of course, that's why the argument is they're overhedged.